What's going on, guys? My name's Emmanuel and welcome to my channel. Guys, our channel is growing and I absolutely love the engagement we all have in the comment section every single video. And guys, trust me, it encourages me to continue to put out even more content and also to continue to share my thoughts regarding stocks. So starting from today, alongside sharing with you the stocks I bought the previous week and why, I'll be sharing with you the stocks that I am currently looking at for the current week ahead and let you know why I am watching those stocks. Share the stocks that you are currently watching this week in the comment section below. I would love to hear your thoughts and your opinions. But before we jump into it, guys, I just want to say that I appreciate every single one of you who tune in, who comment, who like and subscribe. You guys are truly amazing and it truly means a lot to me. So with that said, guys, let's hop into today's video.
The first stock I am watching closely this week is Apple. It has to be Apple, guys. And I uploaded a video on my channel regarding Apple, and I go into much greater detail regarding Apple's future plans and why I love the company, why I'm so bullish on the company, and the link to that video, guys, will be in the description below. However, the reason why I have them on my watch list this week is due to rumors of another major blue chip company who has joined forces with Epic Games to complain of the 30% fees that Apple collect on their payments via their App Store. Now I have to give a shout out to Vinyl Thornbury, who posted this in the comments section. Now his comment said, I was reading up on this Apple's 30% fee charge and it seems that other companies are also joining hands with Epic Games. For example, check this link where Facebook supports it, and then he provides the link and he asks me, do you think it's going to affect Apple stocks in the coming week? And my reply was simply this: thanks for the info, buddy. I hope and pray that it does, at least in the short term, because that means we can buy more shares at a cheaper cost. So let's head over to this article that he linked. So this article states that Facebook joins the growing ranks of companies publicly complaining about the 30% fee that Apple collects on payments made through its app stores. Facebook said that to support struggling businesses, it actually won't be collecting any fees on their events, at least for the next year, which means that those businesses keep 100% of the payments on the web and on the Android. But Facebook said that won't be the case on iOS due to the Apple Store fees. Guys, I do have to admit that I actually see Facebook's argument on this topic. Businesses are currently struggling. There is no doubt about it. And Facebook have decided to offer help to struggling businesses by not collecting any fees on their events. And this will be effective for businesses on the web and on the Android platform. But unfortunately, on the iOS platforms, like Epic Games, they will miss out due to the App Store policy. And if you want my absolute honest opinion, guys, like my brutal opinion, boo-hoo. Cry me a river. Cry me a river, please. Guys, look, the policies and terms and conditions are in place for a reason. The App Store is not the only application platform available for you to operate your business, right? And if you don't like the heat, it's simple. Step out of the kitchen. But the reason why they won't leave is because the App Store is the biggest and the best platform, okay? And it's that simple. So you would rather behave like a child and start moaning and complaining about it. Guys, look, I'm sorry. I don't think Apple should budge on their policies, and that's my brutal, honest opinion, guys. However, looking at the share price, guys, you can clearly see that this caused a few investors to get a bit nervous. Hence the current sell-off that took place at market open, and the stock is currently down about 1% on the day. So I hope this pushes the price even lower, because that will enable us investors to buy a wonderful company at a much cheaper price. Because to be honest, guys, Apple is not a cheap stock, okay? So definitely keep that on your watch list, guys, and look out for more action on Apple. Alright guys, so the next company on my watch list, and it is also on the top of my watch list, is Foot Locker, and the ticker symbol is FL. So if you're not familiar with Foot Locker, guys, they are mainly known for their athletic footwear, or as the US like to call them, sneakers. You know what I'm saying, my sneakers. And we in the UK, we just bland in it, we just call them trainers. But as well as sneakers, guys, they also sell clothes, clothing accessories, sporting equipment for kids. And to be fair, their main audience tends to be millennials and young adults. Okay, guys? So the main reason why they are at the top of my watch list this week is because they're actually reporting their earnings this week. And I believe it's on it's on August 21st, 2020. And the analysts are expecting them to report an earnings of 0.25 cents a share. Okay, so I think the analysts have set their expectations really low, and I don't see Foot Locker missing this. And I'll share with you more information as to why I think they will actually beat these earnings. Now, on the 10th of August, Foot Locker actually had a press release which gave current and potential future investors an idea of how Foot Locker's recovery post-lockdown has been proceeding, and the chairman Richard Johnson actually released this statement. He said, "In the midst of the COVID pandemic, our team delivered strong second quarter results. As we continue to reopen stores throughout the quarter, we saw a strong, I'm going to say it one more time, we saw a strong customer response to our assortments, which we believe was aided by pent-up demand and the effects of the fiscal stimulus, guys." Remember that stimulus that the US government were handing out a couple of months ago? Well, the chairman is saying that this fueled our in-store sales and also drove continued momentum across our digital channels. Okay, so if you ever wondered what people actually did with their stimulus checks, well, I can confidently say that they gave a huge chunk of it to Foot Locker, boy, which I'm sure will actually boost Foot Locker's revenue. And this is why I'm confident that I think they will beat their expectations. So as well as boosted sales, guys, Foot Locker have announced further expansion into the Asian market by revealing their largest store in Singapore. Now, this store is also going to be quite unique, guys, because it will be over 5 floors. The retail side will actually take up 3 levels, while the remaining 2 levels will have a state-of-the-art basketball court. Now, basketball is absolutely massive in Asia, guys, and I think this is actually a really smart move from Foot Locker, because I think overall this will create a fantastic customer experience, and I'm sure they will charge for the use of their basketball court, which will further boost revenue, guys. So I believe these are all great fundamental reasons for at least having Foot Locker on your watch list. But the most important thing for us, and I can hear all the investors saying, what are their financials like, guys? What are their financials? So with that said, guys, let's take a look at Foot Locker's financials. Now, straight off the bat, guys, you can see Foot Locker has a really good PE ratio of 14.56. And if you're not familiar with a price to earnings ratio, Peter Lynch likes to look at the PE ratio as an indicator as to how long it would take for you to get a return on your investment at the current earnings, all right? So a PE ratio of 14.56, you're looking at about 14 years to get a return on your investment. Now, moving on to their profitability, guys, they do have a tight operating margin, which sits at 5.59%, which means for every $100 that the company generates, it keeps just over $5 of that as earnings. So it's really, really tight. And they also do have an extremely tight profit margin, which is sitting at 2.94%, which is something that you have to be aware of, guys. It's really, really tight margins we're looking at. They also have a decent balance sheet, guys, with their total cash position, which sits at 1.01 billion versus a total debt of 3.62 billion. So they are slightly over leveraged, okay, guys? However, their current ratio is sitting at a nice 1.67. And if you've watched any of my previous videos, I regard a current ratio of above 1 as very, very good, because it means that they have enough total current assets to cover their total current liabilities and their financial obligations, at least for the next 12 months. So they have very, very little chance of declaring bankruptcy, at least within the next 12 months, okay, guys? So moving on to their free cash flow position, guys, and their free cash flow position has been a bit choppy. I ain't gonna lie, guys, I usually like to see consistent free cash flow growth. However, their free cash flow is currently positive, but it has had a significant impact due to the lockdown, and you can actually see it from the trailing 12 months. It's a huge jump from their first quarter in 2020. So Again, that's another little bit of a risk for me. It's little bit of, I would give it an orange flag, you know. So I wouldn't say it's a red flag because it is still positive despite everything that's gone on, but it is still a bit of a worry. Okay, so we'll give it amber, not orange, amber. Now, not forgetting the insider transactions, guys, and you can see the directors have been really busy awarding themselves with stock grants on the 1st of July. I mean, look at this, 2,500 shares, 2,500 shares, 3,000 shares. I mean, yo, it must be nice being a director with Foot Locker, boy. Those are beautiful amounts of shares, guys. Now, taking a look at Foot Locker's current market price, and they are currently 36% off their pre-lockdown highs. And I think if they do beat on earnings, which I strongly think they will, I can't see why they can't return to that price, especially if they continue to grow their earnings over the long term. Okay, so this is a company that you definitely want to keep a track of their earnings and watch it grow, guys. Watch this grow. Now, with regards to Workhorse, guys, and I have to give a massive shout out to my guy Jack Spencer from Jack Spencer Investing. This legend, yeah, somehow managed to get the CFO the CFO of Workhorse on his channel for an exclusive interview, which was nothing short of epic in my opinion, guys. I'll put the link to the interview in the description below. Definitely go check it out, as I thought that interview was brilliant. Alright, guys. But when Jack asked him about further details regarding the USPS contract, the CFO couldn't provide us with any more specific information. One thing I can say to you guys is that Mahindra, which was one of the 4 contenders that I listed in my last Workhorse update video, has now withdrawn from its bid to produce vans to the US Postal Service. So, in my opinion, guys, another one bites the dust, leaving our company Workhorse as one of only 3 contenders left to win this contract, which makes it all the more exciting. And lastly, guys, ARK Invest have been buying up even more shares of Workhorse. Their position is currently sitting at 481,771 shares. They have grown this position. I remember it was like back in 100,000 shares when they had a few months ago, and now look, they're sitting at way over 481,000, guys. I don't know about you guys, but this gets me really excited. They have obviously seen something with Workhorse, and I want to be there when this thing pops off, guys. So that's your Workhorse update.
Guys, it's important that you create a watch list for the week. I found that it helps to prevent me from making emotional moves, particularly if you see a random stock that's up maybe 10% and I haven't researched it. You know, FOMO kicks in and you end up buying at the top. And trust me, guys, it's happened to me a lot of the time, and it's mostly led to big losers. So absolutely, guys, create a watch list and stay disciplined. But ultimately, guys, make sure you do your due diligence and your own analysis before you invest in any stock or any company. I'm not a financial advisor. I just love researching and talking about stocks. All the links to help you with your investing are in the description below, including some of the books that I would highly recommend. Plus, my broker Trading212 will send us both a free share if you sign up using the link in the description below. With all that said, guys, don't forget to smash the like button, as it really helps my channel grow. Hit the subscribe button and the notification bell if you want to see more content from me. Thank you once again, guys, for watching, and I'll see you in the next one. Peace.